Back in 2015, Malaysia introduced the Goods and Services Tax, GST, at a rate of 6%. For many Malaysians, GST represented a massive shift from the previous Sales and Service Tax, SST system, which was narrower in scope and applied selectively to certain goods and services. The introduction of GST was intended to broaden the tax base, ensuring a more consistent and reliable revenue stream for the government. However, by broadening the tax base, it meant that some goods and services previously untaxed under the SST system would now fall under the GST regime. This included a range of items and services integral to daily life, such as utilities, transportation, and even certain processed foods. For many households, especially those in lower income brackets, the immediate effect was an increase in living expenses. The cost of essentials such as groceries and healthcare services rose, creating a ripple effect of financial strain across various demographics. This wasn't a favourable policy for many, as it disproportionately affected those who were already struggling to make ends meet. Lower-income households, which spent a significant portion of their earnings on basic necessities, felt the brunt of the increased costs. Unlike higher-income groups who could absorb the additional expenses, these families faced reduced purchasing power and were forced to cut back on discretionary spending. The ripple effect of GST exacerbated existing inequalities, widening the economic gap between the rich and the poor. Hence, just 3 years later, in 2018, the GST was effectively zero-rated, meaning the rate was changed to 0%, and later replaced with a reintroduced version of the Sales and Service Tax, SST. This rapid shift left many wondering, was the GST genuinely bad for Malaysians? Or was it actually a sound policy that needed more time and better implementation? Well, to understand all these, let's take a walk back and start at the very beginning. Before GST was implemented on April 1st, 2015, Malaysia operated under a sales tax and service tax system, commonly abbreviated as SST, which was introduced in the 1970s. The sales tax ranged from 5% to 10% depending on goods, and the service tax was at 6% for services such as hotels, restaurants, and professional services. Although these taxes generated revenue, they were criticised for being somewhat complicated and for not capturing a wide enough base. Different goods and services were taxed at different rates. Additionally, it was argued that the SST system lacked transparency. It was not always clear how much of the final price of a product was due to taxes, nor were businesses necessarily consistent in how they collected or remitted the taxes. Here's a graph on the taxes on goods and services as a percentage of GDP, data that we collected from the Organisation for Economic Cooperation and Development, OECD. As you can see, over the past decade, Malaysia's taxes on goods and services as a percentage of GDP has fallen down. Back in 1991, the highest in this dataset, it was over 10.2%. But by 2014, the year before GST was introduced, it had fallen to just 3.6%. This decrease in revenue meant that the Malaysian government faced increasing challenges in funding essential public services and infrastructure projects. At the same time, Malaysia had faced declining oil revenues as global oil prices dropped, and the nation's reliance on petroleum-related income became increasingly unsustainable. Here's a graph on Malaysia's total government revenues. As you can see, from 2009 to 2014, oil-related revenues were dropping in its share to the total revenues. Lower oil revenues, coupled with lower taxes from goods and services, meant that Malaysia's fiscal position was under increasing strain. Whenever a government's fiscal position becomes increasingly strained, there are 3 ways for the government to fix it. Either it reduces its expenditures by cutting back on public services and development projects, which is not something that would favourably be looked upon, As in general, people would always demand more from their government. Then, the second solution is to borrow money. If the government wants to spend more on things like infrastructure or public services, but can't collect enough revenues through taxes to do that, then they can borrow money, which increases the national debt of Malaysia. That has been one of the reasons for the increasing debt of Malaysia, which, as you can see from the graph right here, since the start of the 21st century, Malaysia's gross debt position as a percentage of GDP has steadily increased. But relying on debt to fund government operations has many limitations. It wouldn't even do any good if the debt were to increase substantially. The third reason for the Malaysian government to fix its fiscal strain would then be an increase in taxes. That is what led to the introduction of the GST. The purpose of the GST was basically to broaden the tax base so that more transactions would be taxed consistently. This would increase the revenue of the Malaysian government. But there's a lot of questions about the difference between the SST and GST, and why at 6%. So we will dive into that first before we talk about the effects of the GST to the Malaysian economy. Let's first talk about the GST. The GST is a multi-stage consumption tax. Every time a product or service changes hands in the supply chain, GST is levied on the value added at that specific stage. Ultimately, the cost of GST is usually passed on to the end consumer, who pays the tax at the point of purchase. SST, on the other hand, is a single-stage tax that is imposed at either the manufacturing or service level, depending on the nature of the product or service. This means that SST is only applied once during the production or service process, and the tax is included in the price of the final product or service. Unlike GST, SST does not involve input tax credits, where businesses can claim back the tax paid on their purchases, which can lead to cascading effects, a scenario where taxes are levied on top of other taxes as goods move through the supply chain. The impacts on prices of the GST were significant and varied depending on the type of goods or services in question. For items that were previously untaxed under the SST system, the introduction of GST often resulted in noticeable price increases. But then, why at 6%? Many countries use some form of a value-added tax, VAT, or GST, often ranging between 5% and 20% or more. Malaysia's 6% actually fell on the lower end of the global spectrum, sitting below the rates when we compare it to other countries. For instance, let's take a graph comparing Malaysia to many other economies out there. Here, you can see that Malaysia's 6% GST back in 2015 was actually very low. Many Western economies, such as Germany, France, and the United Kingdom, had far higher GST rates. Or, while Singapore's GST rate was just 7% back in 2015, it has eventually hiked up in recent years. Hence, by starting at a 6% rate, Malaysia aimed to strike a balance between generating sufficient revenue and minimizing the financial burden on consumers and businesses. The government sought to introduce the GST at a rate that was competitive in the region and globally, ensuring that it would not discourage consumption or harm Malaysia's business environment. So, what were the impacts of the GST to Malaysia's economy? The first is simple, and it's what we've talked about earlier, by reducing the fiscal burden of the government. Here's a graph on Malaysia's government budget balance, data from the Ministry of Finance Malaysia. As you can see, from 2010 to 2014, the deficit was substantial, ranging from 3.4% to 5.4%. But when the GST was introduced, the deficit had shrunken to 3.1% in 2016, and then 3% in 2017. But of course, the fiscal deficit going down isn't just because of the GST, but it's been a major part of it. How? Let's take a look at the earlier graph again on the taxes on goods and services as a percentage of GDP from the OECD. This dataset, while not exclusive to GST or VAT revenues, provides a broader picture of how countries generate income from taxing goods and services. It includes GST VAT, excise taxes, customs duties, and other consumption-based taxes. But GST and VAT plays a major role in it, and we shall see in the graph. Now, as you can see, we now extended the data until 2022. Here, you can see the immediate effects on the increase of the GST. In 2014, the taxes on goods and services to GDP was 3.6%. But a year later, it rose to 4.8%, and another increase in 2016 to 5%. It seems quite small, but it's actually a lot, because we are comparing it to the GDP. So, let's change the unit of measure and use the Malaysian ringgit. Here, you can now see the difference is staggering. The revenues generated in 2014 was just 40 billion Malaysian ringgit, but a year later, by 2015, it rose immediately to over 56 billion ringgit, and by over 62 billion by 2015-2016. That is a difference of 22 billion Malaysian ringgit in just 2 years, a substantial increase that highlights the immediate fiscal impact of the GST. Here's another graph on the share of the GST to the total revenues, which is the same graph that we saw earlier, but this time expanded until 2017. Here, as you can see, the GST share had increased substantially from 7.8% in 2014 to over 19.4% by 2016. That is an increase of 10.6 percentage points in just 2 years. This increased taxes then helped the government address the budget deficits, which had an impact on the federal government debt of Malaysia. Here's a graph on the federal government debt of Malaysia to GDP. Here, you can see the effects immediately as well. From 2009 to 2014, the federal government debt to GDP had increased, but from the years that saw the GST introduced, the debt to GDP had decreased. But of course, it's not just GST itself. It's a combination of factors that led to the decline. The introduction of GST in 2015 expanded the tax base, increasing government revenue. This additional revenue helped reduce the fiscal deficit, allowing Malaysia to manage its debt more effectively. Another impact to Malaysia is the fact that it has helped it stay competitive globally. Let's take the taxes on goods and services again, but this time compare Malaysia to its neighbouring countries. Here, you can see, from 2010 to 2014, Malaysia's tax on goods and services to GDP was the lowest when we compare Malaysia to major economies in Southeast Asia. But by 2016, it has put Malaysia above Singapore and Indonesia. Yet, as you can see again, when Malaysia removed the GST taxes, the taxes on goods and services to GDP had fallen back, and they are now again the lowest from 2018. Before we end the video, let's talk about the negative effects of the GST. The first and biggest downside is, of course, no other than an increase in the cost of living. Despite exemptions and zero-rated goods, many Malaysians felt a pinch on their daily expenses. Lower-income households, which already spend a high proportion of income on essentials, felt they were taxed unfairly. Here's a graph on Malaysia's inflation rate, consumer prices, data that we collected from the Department of Statistics, Malaysia. Here, you can see the inflation rate after the month GST was introduced in March of 2015 to skyrocket. But it is important to know that it's challenging to isolate just how much of this was directly due to GST, since factors like global oil prices, currency exchange rates, and broader economic conditions also play a role. Nevertheless, GST still impacted Malaysia, considering the amount of revenues it brought in. So, was Malaysia's GST bad, or was it needed? Well, the data, and many studies out there, backed the fact that it created short-term pain and political backlash, but it was not inherently bad from a macroeconomic standpoint. It filled a crucial need for more reliable government revenue and reduced dependence on volatile oil income. However, its abrupt introduction, refund delays, and the potential strain on lower-income households contributed to its unpopularity and eventual repeal. But anyway, do let us know what you think. Thanks for watching.